This video is brought to you by the award-winning prop firm, Fidelcrest.
Alright guys, so the first aspect to trading the TGFX strategy is understanding the power of session levels. Now, most people know session levels as New York session, London session, Asia session, Frankfurt, so on. Yes, that's the surface level of it though. What we now have to understand is what these sessions represent and what they do for the markets. Now, the whole point of trading is to make money based off of a movement within pips, right? So this means we need volatility. By trading at the beginning of either New York session or London session, you actually get the biggest burst of volatility in the market. Now, you'll also notice that if you go to something like forexfactory.com, most of the news that is red folded that's going to really push the market happens at the beginning of these sessions.
Fidelcrest is an award-winning prop firm that funds traders with up to $2 million and offers generous profit splits up to 90%. So one thing that really sets Fidelcrest apart is their no minimum trading days requirement on their challenge and verification stages. On top of that, traders who successfully pass the challenge and verification stages are eligible to receive a bonus payout of up to $30K on top of their funded stage profit split payout on performance. And be sure to use promo code TradingNut, all one word, to get 10% off your next challenge. Click the link in the description below or the card above to find out more.
As you guys can see on my chart now, we see that our indicator, which is the TGFX indicator, you can get it off of our website at tgfx-academy.com, but it automatically maps the session levels for you every single day and updates them. So first off, the green color in the background that is overlaying price action is representing an hour before London session going into the open of London session, okay? The open is at 2 a.m. All right, so right there, so an hour before and then an hour after. The purple area is mapping out New York session. So 7 a.m. right here is the start of New York session going into the rest of it. So this is the session we trade right here, which is 7 to 9 a.m. Let's just take this price action we're currently at right now and just kind of understand what's happening. So as you guys can see on the indicator, it's representing London's high correlating to this point here. From that point, price ended up impulsing to the downside, right? Asia's low was created at this point here. As we can see, price came back to it, retested multiple times, found a level up demand, and then took off to the upside. Vice versa, if we look at where price is in this area, we see that price made a high in New York session. We had an impulse down, a retracement, Asia session opens up, and then we get continuation. Here's another quick example before we move on. As you can see at the bottom of the screen, this purple area represented New York session, and this wick was the lowest point in that session. And if we go over to our right, we can see that once price came back into that level, we got a strong rejection that impulse price back up. But if you guys will start to notice, volatility actually steps in at these session highs and lows. So if we're able to actually catch the impulse that are happening around these times, we can catch the move of the day. Now, I like to call myself a scalp entry day trader. And what I mean by that is I like to enter the market with a very tight stop loss of anywhere from 1 to 6 pips. And then overall, my first target is a 1 to 3. But after that, I'm actually holding that trade for an extended target based off of day trader levels. Now, what I mean by that is session levels. So targeting the previous New York or London's high or low, targeting the previous day's high or low. This allows me to target price daily range instead of just that small impulse that scalpers would look for. Now, the main purpose of this is the risk to reward. If we're able to minimize our stop loss, which is the easiest way to maximize our reward, we end up catching crazy trades like 1 to 10s, 1 to 20s, even 1 to 50s. And I know it sounds crazy, but we've also had students that have had these same exact results. All right, so now that we talked about that a little bit, what we're gonna go over next is structure and order flow. So the first thing you wanna understand is structure. Structure, very simply, is just an uptrend or a downtrend, right? So if you look at this screen, you can obviously tell that this point is lower than this point, which means price is moving upwards. If we drew it the opposite way, we can tell that price is going downwards, right? So these points are called lows and highs. In this case here, since it started the leg of structure, we're just gonna call it the high because it's the first high. We're just gonna call this the low. So our next point we're gonna be asking ourselves, is this low higher than the previous one? If it is, then this will be called a higher low point, okay? Higher low point. You can of course abbreviate as HL as well. Now at the top up here, we're gonna do the same thing and ask ourselves, is this high higher than the previous or lower? In this case, it would be higher. So this would be a higher high. All right, and this cycle would continue on pushing up until we peak. Now, after we peak, what happens is we break structure because of the fact that in an uptrend, we maintain higher lows and higher highs. And in a downtrend, we're going to switch to maintaining lower highs and lower lows. So at this point here is where we break structure. All right. And now instead of making higher highs and higher lows, we're making lower highs and lower lows. So what I'm going to do is just copy this. We're going to change this out. We'll do the same thing here. All right, so after we stop maintaining higher highs and higher lows, we break structure and start maintaining lower highs and lower lows. So this is the basics of how the market moves, right? Very simple to understand. Now, what ends up happening where a lot of people get caught is inside of each impulse leg of structure, there's other movement, there's other directions going on. And this is where order flow comes into play. Now, there are a few things that I'm looking for in my order flow. The number one is order blocks. Okay, then we have quasis, we have exhaustion, we have compression, and we have liquidity. All right, so we're gonna go over all of these right now. Now, the first one, order blocks, I'm pretty sure you guys understand from watching the videos on my channel, but just as a quick run through of what they are, how they react in price action. Let's say we had a candlestick that looked like this. Now, from baby pips and all that good stuff, we know it as the bullish engulfing pattern, which is perfectly fine. But we need to understand what this actually means on a deeper level. So if we were to highlight this candle here, which we would call the base of this bullish order block pattern, there are a couple things we would need to point out. Number one, from this wick low of this green candle all the way up to the highest point of it makes a impulse leg on a lower time frame. So let's say this order block is on the H1. Maybe if we switch to the M15, we would see a whole impulse leg of structure instead of just one candle here. So now that we have an impulse leg of structure, what we have to understand is that price is what we call imbalanced, okay? Imbalanced. So the reason it's imbalanced is because now price needs to come back and retest, okay? It needs to retest the base candle before it can now move efficiently, okay? Another word for it is inefficiency, okay? So now the price is moving efficient because it came back, we can now look for expansion. Now also think about this just in the fact of we still have to make higher highs and higher lows, right? So in this case, the closure of this bullish engulfing candle actually gave us a higher high and price is pulling back to retest to make a higher low. We can also call this point equilibrium, as in supply and demand, right? Because if price moves too far away from a price that everyone agrees upon, then there's going to be an imbalance or an inefficiency and price is going to try to snap back to that level. Now that is one of the order block patterns. We also have one called the bullish bearish bullish pattern, which is a continuation pattern. This is one of my favorites. Now, when you see this in the market, a lot of times you'll see the market completely expand after without much of a retest. It'll literally give you a small wick and then expansion. Then we also have order blocks that look like this area. So we'll get a large bearish candle and then a smaller bullish candle. And what ends up happening after this is a lot of times the next bullish candle expands outside the range of the bearish candle, which gives us an engulfing variation or an order block. So now what I'll be looking for is a retest to this base candle. The base in this case will be the small bullish candle versus in this one, it would be the red candle, okay? And in this case, I'm drawing it from the red candle body open all the way down to the lowest wick of the pattern. Here, I'll be drawing it from the top of the green bullish candle's body all the way to the lowest wick in that area, all right? And then obviously we see that price expands, it leaves what's called a imbalance or inefficiency once again, and then it comes back and retests. All right, so I kind of showed you guys imbalances and inefficiencies as far as order blocks, but let's talk a little bit about how you see them in actual price action. So let's use this candle that expanded here. What ended up happening because of the fact that, let's say we had a small wick here, and a small wick here, the fact that this candle traded above the previous candle's wick means that price is moving inefficient and needs to come back and retest it, right? So there's two things that can happen. Either price can continue expanding up and it can leave a gap in the market, such as this, where there still is a range of price that needs to be retested, or what we can see is price will come back and fill in that area. Now, a lot of times price will move away, it'll come back, fill in that area, and then it'll continue the overall direction that the market wanted to move. So once we're aware of all these different signals within order flow, it's kind of like they're leaving footsteps for us to follow and understand where to actually get in the market. Next, let's talk about quasis. Quasi patterns are very similar to head and shoulder patterns. As you can see in this case, since the shoulders aren't even, we wouldn't really call this a head and shoulder pattern. For a head and shoulder pattern, we're really focused on the symmetrical aspects of the left and right shoulder. Now, if we really think about this, it's not going to be very often that both shoulders are actually symmetrical. And the reason being is that every single price point in the market is created by someone injecting liquidity in at any given moment, right? But every single day in the market, there's different participants, which means there's very slim odds of the left shoulder being the exact same as the right shoulder in shape, in candlestick body, etc. So instead, what I like to use is something called a quasi or a quasimodo. Now, in this case, what we're looking for is just as long as price makes a right shoulder rejection, whether it's something like this, whether it's something like this, it doesn't matter as long as price gives us that right shoulder and a bearish rejection, okay? Now, this is going to be a signal for us for continuation in the market, but also reversal. What you'll start to notice as price is making structure is that when price reaches a point or a high, right, what we're gonna start to see is price transition. So instead of continuing to impulse up, you're gonna see maybe on a lower time frame. So let's say the purple is H1. Let's go down to, let's say the M5. We're gonna see M5 structure break, okay? Now, M5 structure is gonna break for the retracement on the H1 time frame. So on the H1, this is probably just gonna be 1 or 2 bearish candles, but on the M5, it's gonna be multiple structure legs, all right? Then when price is ready to continue bullish, we're gonna form another bullish quasi to the upside. Price is gonna swing up. All right, then once again, we'll form a quasi to transition, and we'll continue doing this over and over in the market. So this is one of the best signs of understanding when the market is ready to continue and when it's ready to reverse. Now, quasis can also let you know if the market is throwing you a fake break of structure, such as this. Let's say we're in an uptrend, then structure broke like this, as in we make a new lower low in the market. If we see price form a quasi, as in a left head, right shoulder, like this, after that break of structure, that would invalidate our transition and we would still continue to look for an upwards trajectory in price action. And I'll show you guys some examples on live price action as well. Next, we're gonna talk about exhaustion. Now, exhaustion is basically long wicks, but it's in a specific direction we're looking for. So if we're in an uptrend, we wanna look for exhaustion on the bottom side of the candle. The easiest way to think about it is think about a bow and arrow, right? If you were holding a bow and arrow and you pull back the arrow on the bow, you're leaving that wick. And as soon as you let it go, you wanna see price accelerate very quickly away from the bow, right? So think about it the same way in price action. If I opened here and I pulled the arrow back and I let it go, I wanna see that arrow shoot and expand, right? So the same thing here. When we start to see that exhaustion in the market, it's actually a hint to us that the market wants to make a strong move. Now, something else to keep in mind is that we cannot create those price points as retail traders because it takes way too much money to move the market that much. We also know that's either where banks, institutions, or someone with a lot of money stepped into the market. And if they're stepping in at that point, that could be a clue that we want to be in the market as well. Now, the next topic I wanted to talk about is compression. And compression is basically when we start to squeeze into what other people may call a wedge or some kind of pennant pattern. What ends up happening is price can be in a certain direction, let's say the downtrend structure, but price is starting to make smaller and smaller impulse legs because price is running out of steam. And in this case, the sellers are starting to lose the battle and the buyers finally take over as it squeezes into a level of demand. Now, when I say demand, what I'm talking about is a order block, okay? So we want to see bullish order block over here. We want to see price push into it. Okay, as price is squeezing, it cannot break through, and then it finally transitions back bullish. All right. And lastly, let's cover liquidity. Now, when I say liquidity, what I'm truly talking about is where the money is sitting in the market. Now, if you remember what I just mentioned about exhaustion, we know that banks with a lot of money are stepping in under wicks or above wicks. So if we start to look at the market and understand where the wicks are lying, as well as the structure points, then we know where the liquidity is at. So for an example, at this high here, we know that there's a lot of liquidity sitting above this level. Same thing here. And then on the bottom side of price, we know there's liquidity under each of these lows. So in this case, when we broke structure, a lot of liquidity got cleared out of the market. When we ran this high, a lot of liquidity got cleared out of the market. Now, when we see a uptrend structure going, and we see us run a previous high, we want to see a retracement come in soon after. I like to call this a take profit, because if you think about it, as we run liquidity, we're able to take profit on our trades safely and maximize them before the retracement starts, before the market starts moving back against us. Now, there's also internal structure. So this is what we call external structure, okay? These outside points. But all these smaller movements within is what we can call internal structure. So every time we run a low here, this is sell side liquidity, internal structure. Okay, so the internal structure are the small impulses within structure, within market structure, right? They're dictating order flow. On the extremes of price are actually going to be our external structure. So let's actually go to the markets and see how we can put all this together. So here we have New York session, all right? So New York session started right here in the purple area. And what we can see is that we get a bearish, bullish pattern. This bearish, bullish pattern was created in London session. It created a small imbalance, right? Because the wick did not retest all the way up. So what we're looking for is a retest and then a continuation away from it. So what we're gonna do is drop down to a lower time frame in this area and see how we could have entered the market. Now, actually, before we do that, I just wanna kind of map out structure to you guys as well. So if you see, we had a 2 candlestick pullback here. This bullish candle's wick traded outside of these 2 candles wicks. What I mean by that is we just made a lower low than these wicks. That means that we have a higher low point here to a higher high and we broke structure. So now we're actually in a downtrend structure. So in that case, we're looking for sales. Now, if we drop down to a lower time frame, as I was showing you guys on the example, there's multiple pullbacks within that H1 impulse. So now all these little pullbacks here, this is all internal structure. These are all little levels of liquidity being created in the market. But as you can see, we're focused on this one because we've seen the bearish, bullish order block on the higher time frame. So as price impulsed away, we're simply waiting for price to react to it. We want to see price retest into it. What I'm looking for on the 1 minute time frame is a rejection candle as well as a transition. So if you guys start to notice, we see a quasi left head and right shoulder. So once again, forming this pattern here. So remember, the shoulders do not have to be perfect on these. All right, and next on that right shoulder, we formed a bearish, bullish order block that gave us a level of supply. So this is now going to protect our orders. This gives us a level to take trades from, and from there, we put our stop loss above it. All right, so in this case, we can get a 3.4 pip stop loss. We can enter off any of these rejections or taps. For example, if you wanted to wait for the bearish engulfing variation, bearish order block, or even the bearish order block here, they have a little bit of the bigger stop, but it's not a big deal here, and price literally takes off. So that's a quick example of how you can utilize the different order flow tools to help you in your trading. Now, real quick, I'm just gonna run you through my entry protocol on the 1 minute time frame, and then we'll go ahead and wrap it up here. Now, what I'm looking for on the lower time frame of the 1 minute when I'm looking for an entry are 2 things. Either a break of structure, okay, or a sign of weakness. Now, we're gonna go over break of structure first. And to keep it simple, we're just switching trends, right? So we're going from an uptrend to a downtrend. Now, the reason we want to do this on the 1 minute is because the 1 minute time frame is the lowest time frame we can go to, besides seconds, which kind of gets choppy, but the 1 minute time frame is the lowest we can go to see a break of structure first, right? Because if we want to see a transition on the H1, the M1 has to transition first, then the M2, M3, M4, M5. So it has to work its way up. So the fact we can catch the first transition on that 1 minute is going to put us in the best position to actually maximize our profits and get a very small stop loss. So once we break structure here, what I'm actually looking for is what's called a return to impulse. We're going to create an order block, in this case, a bearish order block, when price impulses and breaks structure. Okay, now once it does this, it's going to create an imbalance in the market. So we're going to want to see price come back and retest that level, which is what we call an RTI, or a return to impulse. This is going to give us the optimal level to get in on before price continues bearish. Okay, so now once again, we can get a very, very small stop loss, and then our profit is maximized because even by the time we get back to this previous low, we're already sitting at a 1 to 4.38. And of course, we can catch the rest of the impulse with the higher time frame. Now, this is what's really cool about this strategy. Let's say that this was the 1 minute time frame, right? If we understand that the market is a fractal, which means the H1 time frame does the same thing as the M1, let's say that this impulse leg is the H1. So we're sitting at a higher high on the H1, and all of this is a retracement for the H1 to get back to an order block. Well, that means we just caught a M1 entry with a very small stop loss all the way back down to an H1 level. This allows us to catch the same move as the day traders and swing traders with a very tight stop loss. Now, the other way we can use to enter is called the sign of weakness. The sign of weakness is basically when we run two short-term levels and then we get a return to impulse, okay? Now, this is used more so when price does not break structure or there's no higher low in sight that can be used, or vice versa, a lower high in a downtrend. So what we're gonna do is mark off our short-term lows that were broken, right? The sell side liquidity of internal structure, and then we get a return to impulse here. So this return to impulse, once again, is similar to this one. There will be an order block sitting up there, which is where we want to take our order from. Once we retest into it, we're looking for rejection and we take the sell trade, which ends up allowing us to get the best entry before price takes off. So I'll show you guys some examples of this on the chart now so that you guys can see how crazy it actually is working. So let's find some good levels here. All right, so for an example, we could take this bullish order block area here. We could also use this area here. Let's go ahead and drop down in both of these areas and see how we could have entered. All right, guys, so as you can see, this was a higher time frame order block. And what I'll do is I'll turn on MTF candles so that you guys can see the bullish order block we're actually basing our trade off of. So let's actually refine it down to this level here. And what we're gonna be looking for is an entry not only based off of the order block, but the rest of the order flow strategy and session levels. So we know we do not want to trade in the white area. We only want to trade in the purple or the green. And as you guys can see, a perfect optimal entry came in around that time. So when price was playing around in this area, what we start to see is that price starts breaking short-term levels. So we break a short-term high 1, we break a short-term high 2 here. And if you notice, price never came back to this level. Now, if it doesn't come back immediately, it's still valid, okay? It's still valid. It's just making a bigger impulse. So price ends up coming back directly in what session? London session. This is how cool it is. It always sets up the next session. So price comes back perfectly, taps into it, gives you a bullish rejection. We also get a bullish engulfing variation here with these two green candles. And then we get a huge explosion in price. So let's go ahead and map out our long position here. So in this case, it would be about a 4 pip stop loss. And as we can see, price just took off. So to the high of this wick right here was already a 1 in 12.9 risk to reward. And as you can see, price came back one more time in New York session directly in our window of time before impulsing to new highs. Now, of course, this would have been a quite crazy trade to hold, but as you can see, without getting stopped out, we could have been sitting anywhere from a 1 to 26 risk to reward all the way up to a 1 to 34 risk to reward. Now let's go ahead and check out the other trade here. All right, so we're gonna leave on MTF candles here, But let's go ahead and change the resolution of it. So let's go ahead and change it to 4 hours. All right, and what we can see, it turns into that bullish order block area we're actually looking at. All right, so as you guys can see, it comes in, taps our level during London session, pushes a little bit deeper, and it starts giving us compression, right? Because price is starting to squeeze into a tighter point. We finally get that breakout, and that breakout gives us a break of a short-term high 1 and a short-term high 2. So very similar to the previous session, this allows us to have an RTI point. So if we scroll to the right, what we can see is price taps it perfectly, gives us a bullish order block, then another bullish bearish bullish before expanding. Now, in this case here, we could have simply took a trade off of the bullish order block area, okay? In this case, again, about a 4 pip stop loss. And boom, around a 1 to 11 just for right there. And as you guys saw, price continued expanding up after that as well. Take care and happy trading.
Folks, I'm here in the black bull markets trading floor and I'm surrounded by their customer support agents who are ready to take your calls, emails, or live chat 24/7. Now, if you're a newbie or experienced trader, you know your trading's in good hands.